Let's say the GP only invests in companies whose end markets are growing by 3 or 5%. In this case, you should see a consistent pattern of positive value creation here in the addressable market growth. What if the GP claims that sales execution is core to every value creation strategy because they focus on professionalizing company sales forces and building channel partnerships? Then you should see significant value creation coming from market share growth in most deals, and this should be a positive number regardless of whether the company's end market is expanding or contracting. If the GP claims to have a strong operational focus, then expect to see a pattern of positive value creation over here in the EBITDA margin. This deal has modest EBITDA margin expansion of $18 million, but we can drill down further and see its underlying mechanics. The company actually generates $92 million of value from gross margin expansion because there's a decrease in COGS as a percentage of revenue. Unfortunately, most of this gets wiped out by $76 million of negative operating margin reduction because there's an increase in SG&A as a percentage of revenue. That highlights some of the P&L driven value creation, but what if the GP claims to have a deal structuring advantage? For example, they usually invest with participating preferred securities. This should cause the GP to often own a higher percentage of company equity at exit compared to entry. And this would reveal itself as a pattern of positive value creation from fund ownership impact. Here, fund ownership impact is negative, which indicates dilution. It's not necessarily a bad thing. It often happens in successful deals where management option pools kick in and expand. Okay, next we turn to the total leverage effect, which represents one of the most important advances of this model. It includes the cash flow generation term, which is simply the change in net debt found in most of the conventional value creation bridges. If you want, you could split up cash flow generation to measure the impact of interest payments and the debt tax shield. Many researchers do that. However, this still would not account for debt's amplification of equity gains and losses. For that, you need gearing. This addresses the fact that in levered deals, when enterprise values change, equity values change more, either positively or negatively. Gearing also accounts for growth equity on the balance sheet, which for a given enterprise value change makes equity values change less. Most models fail to address this fundamental value driver. Now, because this model quantifies gearing down to the dollar, we can make hypothetical comparisons to competitors. For example, buyout deals usually have more debt than publicly or family-held peers. So you can ask, how much gearing would there have been if the company only had as much debt as the typical sector competitor? You see the answer here in sector gearing, and then this excess gearing term quantifies how much extra gain or loss was driven by the fact the company had a different debt level. Speaking of the market, most models usually include some form of multiple expansion, and so do we. Here we break multiple expansion into a market-driven component and a company-specific component called intrinsic multiple expansion. You would expect positive intrinsic multiple expansion if the GP buys below market, sells to a strategic, accelerates the growth rate, or materially improves the quality of a company's revenue or earnings. In this case, it's negative, which means the company didn't completely ride the market valuation wave, and it's something you might see if a GP slightly overpays at entry. By the way, if a company's unrealized, this intrinsic multiple expansion term can give you some insight into whether the valuation is reasonable. We mentioned 3 market or sector value drivers so far. They are addressable market growth, market multiple expansion, and sector gearing. We could add these up to create a new value driver called the market-driven return. This is very similar to what you might get from a public market equivalence or PME analysis, but in a lot of ways this is better than PME because PME is a top-down measurement of opportunity cost, the return you could have achieved if you invested into something else. Here we have a bottom-up measurement of how the market influenced the company's P&L, valuation, and capital structure, and therefore its returns. This gives you a lot more control in tailoring market metrics to a specific investment size, type, or industry. And believe it or not, the math is easier than PME because you don't have to deal with cash flow spreadsheets and index data. Later videos will discuss precisely how PME and this approach compare to one another.